Hi, good morning. We're going to start the webinar now. This is Richard speaking. If you can hear me, can you give a response? Okay, we'll start now. So, first thing, we had a report today. It was just an update for the SMRT. So, as all of you all know, last week there was a major disruption, and so we had an update report. So just a few bullet points. Well, first thing is that with the disruption, I think everyone will be expecting them to have a serious fine and how this will impact um, the company. Um, so in the report, we actually showed how much SMRT was fined, the four most recent fines that happened last year in July 2014. And based on that, using that as a benchmark, we look at whether there was damage and how many stations were affected. We can only speculate that the fine would be somewhere between maybe 3 and 7 million. Uh, some of y'all might have read in the papers that the maximum fine is about 50 million. Yes, probably if they are given a maximum fine, it will be about 50 million, but it's not very, I think it's very remote that LTA will fine them that maximum amount. Uh, Next bullet point is that what to expect is that their preventive maintenance regime will continue to weigh on their margins. So you can see that system reliability isn't at where they would want it to be, and so you can expect that SMRT would have to have more expenses for repair and maintenance activities. Next is focus on what is already known to understand what is the minimum downside risk. So uh, nobody can guess how much the fine will be. That's for LTA to decide. But what investors should focus on is that now you know that R&M, repair maintenance, has been inadequate, and it would have to there would have to be an increase in expenses on R&M. And then LTA had also announced in January this year that there will be a tightening of the operating performance standards for trains as well. So you can expect that again, even more resources would have to be diverted to keep up with the enhanced standards that is expected of them. And um, in February this year, Transport Minister had commented in Parliament that maybe next year there will be a negative 1% fare adjustment. So you can see that it's not going too well for the train segment because average revenue might come down next year if there's a 1% negative fare adjustment, whereas their costs for maintaining standards through repair maintenance would actually be going up. So because of this, the train business could actually potentially undermine the entire group's profitability. And so based on the FY 2015 results, their full year results, a sensitivity analysis shows that if the operating margin for the train business drops by 1 percentage point, that would actually translate to about 7% reduction in the group profit. Uh, okay, so if you want more details, please refer to the report. To conclude, actually, we still maintain our reduced rating on SMRT, and because of we think that they would have to experience a higher repair maintenance cost, we have lowered the target price to 137 now. Okay, moving on, I'll hand over to my colleague who will speak on macro fundamental and market outlook.
Morning, everyone. This is Lindsay, your macroeconomist covering Asia ex Japan. So just a quick recap on what actually happened in the China and Hong Kong market after the dramatic plunge that we have seen in the past few weeks. So here I've put up a chart of the Shanghai Composite Index price. The SHCOM index chart, along with some call out bubbles of the significant events. So as we to sum up what actually happened since 2014 till date. So there are weaknesses in macro fundamentals and concerns of hard landings in Chinese economy amid reforms. So all these, right, actually fueled speculations of monetary easing policies, stimulus measures that government would roll out, and all this speculation has actually fueled the rally, which we have seen since last year. So it actually went up and peaked at mid of June this year. Also, what we have seen in the November side, mid of November, where the rally started to went up fast, is also due to the debut of Shanghai Hong Kong Stock Connect. So that also supported the upward trajectory. However, in the past few weeks, we have seen the meltdown, which actually vaporized about 3.1 trillion US dollar from the Chinese stock market. And since then, the government has the main priority of Chinese government is to try to maintain liquidity in the system, try to prevent a market fallout, and also avert a systemic risk. So what they have do is they try to support and stem the fallout by cutting interest rate and lowered the required reserve ratio, halted 28 IPOs. They have called for brokerage firms to invest into equities market. They have reversed their margin financing rules and regulations, which I believe that you can recall that they have tried to curb speculations and manage credit risk to and that actually caused some corrections in the market earlier in the year. Yeah, so they have actually reversed that restrictions. They've also banned major shareholders for selling in the next 6 months. They've also launched a crackdown targeted at malicious short selling on stocks and indices. So all these measures that they have rolled out almost every day since early of July. We have these are actually being seen by the public as government's desperation. So all these actually contributed to the fall. And also not just the government intervention, herd mentality, and also herd mentality actually also caused the spiraling down of the Shanghai Composite Index. Retail investors, they are concerned about the overvaluation of many stocks and the credit risk that the government is trying to curb. Yeah, and that actually caused the spiraling down of the huge correction in the market. And also some investors, they are taking profits after the major rally here. So all these three factors actually causes the fall. Notwithstanding that, there are also external factors. For example, weak global demand as well as the Brexit also fueled the plunge. Nevertheless, as we can see last week in Thursday as well as Friday, the market has actually recovered by a bit. And year to date, the Shanghai Composite Index actually has a positive about 20% return, and ever since we have put a overweight call on Chinese market, for the last 1 year it has actually gained about 90% return. So yep, just to touch a bit on the macro fundamentals of China, as you can see that the export as well as import is still weak, and indicating that global as well as domestic demand is still slow. Industrial production has yet to pick up. With this, last week they have also released data on inflation as well as producer price index. We continue to see a disinflationary risk pressure here due to overcapacity issues as well. And we are combining a low disinflationary risk as well as economy slowdown. We are expecting a policy rate cut soon. Although that we have seen interest rate cut being the fifth time as well as a few times of the required reserve ratio being lowered. We have yet to see the credit cycle to kickstart, and the new loans growth remains subdued. So with all this, an easy monetary policy should be able to also support as well as to support the equity market as well as to support the real economy. Nevertheless, there are some reliefs in the real economy as well. As you can see that the PMI is recovering for services sector as well as manufacturing side, and for property market as well. As you know, that property market is a very important sector for the Chinese economy, and the slowdown in the property market has been one of the factors which actually weigh on the Chinese economy. But ever since that government has eased mortgage policies and loosened property restrictions, we have seen a turnaround in May. We are not expecting that there will be a huge rebound soon, but a gradual recovery, and this should be able to support the real economy as well. So economic fundamentals should be improving towards the year end as reforms and stimulus trickle down to the real economy. And more reforms progress should be able to help to attract more foreign participation in the Chinese stock market, especially when the China government is trying to open up open up their capital account. With that, a more diversified investor base should be able to reduce the volatility in the equity market as well. So our view on the equity market is that ever since the rebound, the rebound in last week Thursday as well as Friday, if the market continue to stabilize, we are not expecting to see such a dramatic drop in near term again, because individual participation would be more rational than before, and also we are expecting that it's likely to we're expecting a slower participation pace as compared to before, where margin lending is margin refinancing is a frenzy where it contributed to the huge rally. However, if investors continue to have a low confidence, then we might be seeing the sell-off to continue in near term, and that will hamper Chinese economy growth, and also it may spill over to global market, especially in the Asian markets as well as the commodity markets, namely the oil and metals. So with considering all these two factors, and that we understand that China still has a long way to go, and with that, we downgraded China to neutral weight from overweight. So just to touch a bit on the Hong Kong side, as you can see that Hong Kong is the Hang Seng index had the worst sell-off since the global financial crisis. Although that they are having strong macro fundamentals compared to their Chinese counterparts. So with all with keeping this in mind, that hence we are of the view that H shares are actually more attractive compared to the A shares in terms of both fundamentals as well as valuations. Where you can see that is both PE and the PB ratio are actually still below its long-term average. So this is just a chart that I've pulled out to indicate the AH premium index, where you can see that the A shares counterparts are still is still trade at a premium compared to its H shares counterpart. So with that, with the impending Shenzhen Hong Kong Stock Connect, which we are expecting it to come online in the second half of the year, as well as the QDII2 scheme and the mutual fund recognition scheme. These three events should trigger more southbound inflows and increase the demand for H shares. With that, I would like to conclude our stance that we downgraded China to neutral weight and maintain our overweight stance on Hong Kong. So these are just a few unit trusts and ETFs which you can look into. Okay. Next, I would like to touch on Philip, our weekly tactical view for this week. So just a recap that China has actually eclipsed Green's 4